The SMSF property rules have changed, and if you've been anywhere near the news, you already know residential borrowing inside super is closing on the 10th of August. So the question everyone's asking me right now isn't what's changed, it's whether an SMSF is even worth it for property anymore. That's what we're going to answer today. To help me get to the bottom of it all, we've brought in Alan Cuevas from Foundation Property, who sources property in this space day in and day out. So let's get straight into it. So we've got Alan here from Foundation Property. We've introduced you already. Let's discuss some of these changes at a high level. I guess from both my perspective as a broker that works in the lending space, and then from your perspective also as a buyer's agent. So I guess from a lending side, what used to be able to happen, and a lot of people would have tuned into this, is you were able to leverage funds to acquire residential property. Or commercial for that matter.
Yep.
Okay, so the whole purpose of a limited recourse borrowing arrangement was that you were able to use that to acquire funds and then use that to actually purchase a property within a self-managed super funds as the vehicle to be able to acquire that asset. So the major thing that's changed or is about to change is that limited recourse borrowing arrangements can no longer be used to acquire residential property. So that's going to have a quite a big impact in the market. I guess you would say we're already starting to feel it because it sort of compounds off the changes that have already been introduced into the market with negative gearing and also capital gains reforms. So I think that is definitely going to change the landscape in the lending space. What is clear to us as we know it is that you're still able to use a limited recourse borrowing arrangement to acquire funds to actually purchase commercial property. So that is not touched for now. And there's also other ways for the general public to be able to acquire assets through a self-managed super fund without the need to actually use leveraged funds. So I guess that's the main couple of things that I can pick out from the lending side. But maybe if you can enlighten us on the property side and what you're seeing.
Yeah, I mean, look, these are massive changes, and what a lot of people don't realize is why a lot of people were buying property through their super is to get the advantage of leverage. So the question is, okay, what's leverage? So leverage is like, imagine you've got $200,000 in your super fund and you'd be getting a return on that $200,000, yeah? So you've got $200,000 in there, maybe you've left it with your retail fund, and the retail fund is maybe giving you 6 or 7, 8% per year on average. Yeah, so at the end of the 10 years, how much is that $200,000? What's that $200,000 balance? Getting a 7% return. It might be worth like $400,000 as an example, right? We're just kind of looking at that first scenario. So what people were doing, what you were able to do before these changes came in, is you could take maybe 200,000 of that balance, and you could go and leverage. You could get a loan. So you use some of that cash balance. Maybe you could go and buy a property worth $600,000. And that's where you get the leverage is you don't get a return on the $200,000 that you put in as a deposit for the property. You now start getting a return. As long as you find a good property, you'll get a return on the value of the property, which is $600,000. Make sense, right?
Yep.
So then what that means is that if you're getting a 6 or 7% return, if you found the right property, if you get a 6 or 7% return on $600,000, and that's, doubles in around 10 years from now, well, your asset is now worth $1 million plus, $1.2 million. That's the scenario, and that's what people were basically able to do before. And that's why a lot of people were choosing to get out of, let's say, managed funds, like retail managed funds, where they're managing hundreds and thousands of people, right? Just managing this pool of funds, and your fund's in there, and they're charging you yearly fees or whatever it is. And then people were taking their own funds and saying, like, I want to control, I want more control over my money, over my retirement money and my outcomes at retirement. So I'm going to go and buy a property. I'm going to get that leverage. And now you can't do that anymore because they've cut out this LRBA, or the limited recourse borrowing. And that's the big change, and it's affecting a lot of people basically.
Yeah, I hear. Yeah, it's definitely a massive change. It's going to shake up the market. I guess the next question that would naturally pose is, if somebody was thinking about setting an SMSF up, or were in the middle of setting up an SMSF, and you've got this cutoff that's impending, what happens to them? And for those that have got existing loans in place, like what also happens to them? Because if they're with a particular lender and they manage to secure that property well ahead of the deadline, are they then stuck with that particular lender, let's say for the next 30 years? So I guess that's a couple of things that we can cover off on. I guess with the refinance side of things, one thing that is a little bit clear to us at this point, we're still waiting for the actual guidelines and legislation to be concrete about everything, is that you could still refinance existing loans, so grandfathered LRBAs. So that still gives you the scope to be able to look at the market and compare and see if there's anything that's a little bit more compelling out there. We can always shift and give guarantors the option to look at different lenders. So that's one door that's still open. And one that, and of course, this is not accounting advice or legal advice for that matter, but the other option that I have had in discussion since these changes have taken effect or about to take effect is combining with other self-managed super funds to still be able to acquire residential property, but without the needs for getting finance to do it. So, for example, if me and my wife, we've got a combined super of 300K or 400K, we bundle up with you and your wife, and you've got a similar amount, 300, 400K, we could purchase a $700,000 or $800,000 property outright without the need for funding. That's still possible under the new changes that have taken effect. So
yeah, you can still buy residential property, but you got to pay cash. So you can't use some of your balance and then get a partial loan and then buy that property and get the leverage. You can still buy residential property, but it's got to be, you've got to have enough cash balance in your super to do that. Whereas before you didn't have to do that. You were able to just have a smaller cash balance and then get the loan and then buy the property. Now you've got to have the full cash amount in there.
Yes.
And that's where it's affected a lot of people, because most of these people, most of my clients, one of the things that annoys me is that the government's kind of, whether you agree with them or not, they've kind of said that the reason they're doing this is to help the housing market, to help people get into the housing market. But then, okay, that's fine. We all agree that we all need more housing, right? It needs to be more affordable. But for a lot of people, this has affected their livelihoods. Like, we've helped a lot of clients buy very good property. They've been getting very good returns, great capital growth, great cash flow. And most of our clients that bought property through SMSF, they're all mum and dad investors. Whereas, if you look at the story or the line that they're trying to spin is that, we want to remove these loopholes that all these, rich, greedy, wealthy investors that they have, we want to remove that because they're trying to get into these loopholes. It doesn't make any sense to me, because every client that I've helped to buy a property in super has been a mum and dad investor. It's been a nurse, maybe an IT professional, maybe even a tradie. These are all people that all they wanted to do is they wanted more control over their money, and they wanted to buy maybe one, maybe two properties in their super fund, hold that for maybe 20, 30 years, have it paid off, and then that would be their nest egg at retirement. And now they don't have the ability to do that. They've got to, there's other options out there, but the government's just basically removed that whole option.
It has, yeah. Look, it's introduced a big gap in the market, but having said that, it is unfortunate. It's out of our control at the same time. So the question here is, for those that have set up SMSFs or are still thinking about it, there's still other doors that are open. There's still other avenues for them to be able to.
You've got to find. That's what's happened.
Yeah.
And then you got to find a way. There's other ways. Like there's other pathways. And if you are looking to set yourself up and you want to use property as a vehicle to help you get set up, then there's other things which I guess we're going to talk about. Yeah.
Yeah. So we've established that we can still refinance if they've got existing LRBAs. So that's great. That's one tick. There's still the option to buy into residential property if they're willing to merge with other SMSFs to make that happen, just depending on the balance and, of course, obtaining the right advice, both legal, accounting, and finance advice to make that happen. But it's still possible. And there's also, what we haven't touched on yet, the ability for us to look at commercial property and commercial assets. So that's also another big window or big door that is still open, wide open, for us to be able to take advantage of in that space, which shares a lot of the similar DNA in terms of the actual process and the sequence and what's required. And it still does work in your favor in terms of looking at your future outcome or your retirement nest egg, if you will. There's still a couple of things here before we go into that, though. One of them is directed in terms of the broker and the lending. Does protection hinge on a signed contract or unconditional finance? I'm getting this quite a lot, especially with the cutoff being the 10th of August, or when these legislative changes are going to take effect. And why does that difference matter too much in someone's timeline? So I think it's important that we discuss this because a lot of people are rushing to get their finance through, to get the applications through, to get the approvals through, and to get a signed contract. So the actual changes take effect from 10 August 2026, but the contract itself needs to be exchanged on the 9th of August. So it needs to be actually exchanged and dated on the 9th of August. That's the last day before the changes take effect. So it's not necessary that you have an unconditional approval by that particular time, so long as you've got an exchange contract in place. So that's also another thing that's probably important for people to understand, is that you don't necessarily have to have a formal approval in place, but you do have to have a fully exchanged and signed contract by that 9th of August. Have you got any thoughts on that?
Yeah. So you probably don't want to leave it to the very last minute till the 9th of August, because if you're going to safely purchase a property, you probably still want to go through some more due diligence.
Yep.
You want to make sure that you get the approval. You want to get formal approval for your finance, and you might want to get like a building and pest report done. You want to make sure that the property's safe to buy. There's no major issues or anything like that. And the problem is if you wait, let's say, till the 9th of August and you get an executed contract signed by both parties, but then you're doing all your due diligence after that date, you can't change your mind after that, or you can still get out of the contract, but then you don't have the time to get another contract signed just in case there's something wrong with that property. So yeah, just something to be aware of. Like really, I think, for us as a buyer's agent, we're helping a lot of people do it last minute now. Like a lot of people have come to us and said, like, I need to get this done before the cutoff, and we're working really hard to help those people. But I think for a lot of people who are still setting it up, they might not be able to do the residential purchase anymore. But just try to do it, make the moves, get it done, focus on it, and try to get it done before as much as possible before the deadline, as early as possible.
Yeah, definitely. I think we've got a duty of care to sort of involve that sort of discussion or incorporate that into our discussion with the clients, because especially me, I'm seeing a lot of applications come through. I'm seeing a lot of haste with people wanting to get this done, or that are halfway through it, and speaking to their accountant and speaking to a planner and speaking to me at the same time and trying to get things through before the cutoff. So a lot of that due diligence does get left on the table, or they absorb it. So I think it's important that they understand that, at the end of the day, this is still a little bit more layered than a conventional loan setup. And SMSF is still a pretty convoluted vehicle. It can be. So it's important that they take the time to understand those steps.
Yeah, and also, yes, there is a very short deadline now.
Yeah.
But you still want to make sure that you buy a good asset. That's going to cash flow well, that's going to grow in value, that's going to help you. I mean, why are you buying that asset? You're buying that asset to help you for retirement. So, people are going to be careful about what they buy as well. Not just buy anything. You got to buy something that actually works. That's going to actually, work for your goals. Yeah.
You don't want to be stuck with an asset that doesn't perform or underperforms.
Exactly.
Just because you're trying to meet a certain deadline.
Yeah.
And then you can't make that change afterwards. So it's definitely an important discussion for them to slow down and to understand before they take any steps. So there's a couple of things that we can introduce here. I've got a couple of case studies that we can possibly discuss on both ends that represents opportunities for people to continue to invest after these changes take effect. So one is the business owner. And I think that this is probably something that you would come across in your in day-to-day expertise and conversations, and same with me. But a business owner that is buying their own premises through an SMSF, what does that actually look like? And more importantly, who's it right for?
Yeah, so it's quite a lot of business owners do this.
Yeah,
where they'll actually buy a property through their SMSF. So their SMSF actually owns the property, but then they can lease that property back to the business. And what that actually helps that business owner do is that they own the asset in their SMSF, which ultimately is going to be their asset at retirement.
Yep.
And instead of paying rent to someone else, they're paying rent basically to themselves. And obviously get legal and accounting advice over this, because that's not legal or accounting advice. But that can really work well for business owners who want to run their business out of a commercial property. Yeah.
It leans into helping them with their future goals, with their future retirement goals. They need to pay rent anyway.
Yep.
Because that's part and parcel of the cost and expenditure of running a business. So if there's a way for them to be able to do that and still be able to build wealth and look after their retirement future, then that could be something that aligns very well through an SMSF if they get the appropriate advice on it. So I think that's definitely a good pathway that business owners can and should explore, that they have been doing before these changes took effect. But those that didn't really look at it in detail before can now look at that with a bit more enthusiasm, if you will. The other one is for people that already have got residential in their super, but they think that the door's now shut. So where does the pivot to commercial property or commercial assets fit for them?
I think it still comes down to balance, whatever the balance you have in your super is. Yep. Because commercial is, often people start with residential, and that's where the equity is built. Residential assets, the right type, can, they can build the equity.
Yep.
Right? And commercial is more about cash flow. And then if you're looking for a quality commercial asset, you could be spending $700, $800, $900, $1 million. And obviously, if you're going to be spending that kind of money, you'll need to have the deposit and the purchasing costs to go and acquire that asset. But if you do have the right balance, commercial can work really, really well. It just works differently to residential. So residential, you'll typically get a negative net yield, a negative net rental income, but you'll get good capital growth. Commercial property is about getting, let's say, less capital growth, but you'll be getting a positive cash flow from day one because the tenant pays for all of the outgoings. So you end up getting a net income into your SMSF. So let's take an example. Let's say you were going to go buy a, $800,000 commercial property, and it was getting let's keep it simple. Let's say it was getting a 5% net yield. That's $40,000 of net income coming in into your pocket, right? And if you think about that, if you had a commercial asset worth $800,000 with $40,000 coming into your super fund every year, that's a lot of cash coming into your super fund. That's almost like you had an extra family member earning, let's say, $380,000 a year, putting in their 11 to 11.5%, is it, contributions?
Yeah, it's 12% now.
Is it 12%? Yeah, I can't keep up, right? So the 12% contributions coming into your fund, and what that enables you to do, if you've got an asset like that in your super, I mean, your cash balance obviously is growing much faster. So it can work really well for a lot of people, but you've got to have the right balance in the funds to do it, and you still got to find the right asset as well.
Absolutely. Look, I think there's two takeaways for me from the lending side when you mentioned that you need to have the appropriate funds to go into it. Resi versus commercial. I mean, LVRs are a little bit different. So in residential, you can go up to 90%. Not very popular. Most land on 80%, but you do have the ability to go up to 90%, which means you don't have to front up that cash flow. Whereas with a commercial property, the LVRs sit anywhere between 60 to 70% typically.
Yeah.
So you need a lot more from your cash management account to go in to cover that upfront costs.
Yeah.
And probably the second thing that I took away from that as well is it sort of depends where your journey's at. Like if you've just set up an SMSF and this is your first property and you don't have the luxury of buying a residential property because of these changes and you're considering commercial. And as you say, commercial's wired a bit different. Residential is more of a long-term play. You get capital gain, you get that equity over a longer time horizon. Commercial, you might have the same time horizon, but you've got a bigger cash flowing asset. So that could benefit you if it is a property and you've still got 20 years or so till retirement phase. You can use that additional net yield to aggressively pay down the loan.
Yeah.
And
They
then
work differently. They just work differently. Yeah, they both got like their pros and cons, and they just work differently basically.
Yeah. But if you have that additional yield to be able to pay down the loan aggressively, by the time you reach retirement phase, you've got either an asset that's completely unencumbered or very, very low balance that'll continue to give you that high yield.
Yeah.
Or potentially something that you could sell later on.
Yeah. I mean, if you could think about it like this. Imagine you bought a commercial property, for, again, we'll use the same numbers. We'll call it $800,000. And you held that asset for 20 years. And in 20 years, it might be worth, let's call it 1.6. But if it's completely paid off because it's had a net positive cash flow, right, into your fund and the property's paid off, at $1.6 million at around a 5% yield, that's $80,000 of pure cash flow that you just get. Like it could just be like a passive income, right? And that income's still going to grow because rental income on commercial assets, depending on the asset, they're usually in line with CPI. So say it's inflation or CPI is like around 3%. That rental income is going to keep growing at 3% as well. So, yeah.
Yeah, so that's great. That's great. And I'm thinking, like, if you're buying a commercial asset and you've still got a longer time horizon till retirement, you can still use those additional funds either to aggressively pay down the loan, or you can just have that grow and compound in your cash management account, so that 10 years from now you'll have enough accumulated so that you can go again.
Yes,
and purchase
definitely
another asset and continue to build. Or worst case scenario, you could sell that asset, use the actual funds left over, along with that built up cash in your cash management account to acquire a bigger asset.
Yeah, exactly. Because the example I just gave was just buying one commercial asset. But let's say 10 years down the line, your cash balance is high enough and you're able to get a second one. I mean, what if you had, $2.5-3 million worth of commercial property by the time you retire, and you're getting a 5% net yield. That's you're talking about $150,000 of passive income.
Yeah,
and the property's paid off. So
yeah, that's great. So I think, look, there's a couple of outgoing questions to cap this off. Like pulling those three scenarios together. The question is, and I think we've clearly answered it: is SMSF still worth it for property, and who is it actually worth it for now? That's you, buddy.
I don't know what to say, naman. All right, what was the question?
So pulling those three scenarios together,
Yeah.
is an SMSF still worth it for property? And who's it actually worth it for?
Yeah. Well, again, we're not giving financial advice here.
No, of course.
Speak to your accountant, speak to a financial advisor, before you do anything. You're a loan specialist. You specialize in loan products and finding the right loan for the asset. Where as a buyer's agent, our job is to find the right asset. So I think, look, it's for people that still believe they want to use that property is the right vehicle. At the end of the day, it's an asset, right? It's a vehicle to get you from point A to point B. Right? Here's where you are. That's where you want to get to. And if you still believe property is is the right vehicle to get you to your retirement goals, then the option is there. And like we've spoken about, it's still a great option. You probably, the window's closed basically for anyone wanting to buy a residential property. As of today, what's today? It's the 22nd of July.
20th.
You've literally got a week or two to buy a residential asset and get the leverage and get a loan. But after that window closes, for people who do believe in property as a vehicle, commercial property could be a really good option for some people, because you get a net rental income, which means you're going to have positive cash flow flowing back into your self-managed super fund, and you're going to get rental growth as well, right? You're going to get probably 3 to 4% rental growth on the asset. So that income is going to grow, and that means the cash flowing back in as well is also going to grow year on year. And then let's say 10 years down the line, maybe even sooner, depending on how well the asset performs, you might be able to go and acquire more. So
that's a good take. And I think the other thing is, and I've had this discussion with both applicants and BDMs, is that if you've got a pre-approval in place and you don't manage to find a residential property before the cutoff because you're doing the right thing and you're doing your due diligence and making sure that it all stacks up, if you don't find something before that cutoff, you don't need to stress either. There's always the option for us to be able to pivot that pre-approval for it to suit a commercial asset instead. So I think that's one thing I want to point out, because a lot of people might not know that. They might just overwhelm themselves or pressure themselves into trying to find something before that cutoff date, and then if they don't, then I think that door's just completely shut. But it isn't. So there is an option for them to just pivot and move that pre-approval across to a commercial asset instead, and still continue to do their due diligence, but without the added pressure of any timeline or time frame.
Yeah.
All right, I got one more question for you. What's genuinely different about the person this suits today versus a year ago? I think I'll lead on this one, and I'm keen to hear what your thoughts are. But I don't actually think that the person today versus the person a year ago is any different. Like, I think this particular scenario, if you've considered a self-managed super fund as a vehicle to be able to acquire property and support that throughout your retirement or your retirement journey, I think that's going to be exactly the same either before or after these changes. The only thing that's different is the actual asset itself.
Yeah.
But the due diligence, the thought process behind it, the people that you speak to, the reason why you do it, that's all the same to me.
Yeah.
So
yeah, I'd agree. Like, the people that we were helping a year ago, the whole reason they were doing it is they just wanted more control over their retirement funds. They believed there was a better way to do it, other than, let's say, leaving it with a retail fund. And they believed that property was the right vehicle to get them there, to their goals, to their retirement goals. And that hasn't changed. People still, I think, are still in the same position. They realize that, however they've got things set up, that they can see that their balance isn't going to get them to where they want to get to. By the time it's not going to be at the right balance they need at retirement. And so they're looking for other assets or other vehicles to help them get there. And depending on the asset, like property can still help you to do that, as long as you do it in the right way.
I think the other conversation that I had pretty frequently was that the reason why they discussed or thought about self-managed super fund, apart from wanting control over their future and their actual super, is that they were quite heavily leveraged in their personal assets. So they couldn't really, their borrowing power was already reached on the personal side. So they still had the appetite to continue to invest, to continue to grow their wealth, but they were just limited by the capacity, their lending capacity on the personal side, so that they looked at the balance that they've accumulated as a family and thought, well, we're going to use that to take control and to continue to invest.
Yeah, I mean, that's a really good point, and you should probably expand on that. Like, a lot of people didn't even know that they could do something through super, they didn't know that they could actually borrow money through a self-managed super fund. And it is, I mean, you would know that it's kind of separated from your personal borrowing capacity, and you're able to acquire more assets through your super fund.
It is, it's mutually exclusive. So it still allows them to continue to grow. So yeah, that's great. I think we've covered quite a lot in this discussion about the type of people that we can help, the people that we can continue to help after these changes take effect, what we used to be able to do and what we still can do. And I hope that this has definitely enlightened a lot of people into what pathways they can take even after all of this comes into effect. All right, that's great. Thanks a lot for coming on, Alan. So before we wrap this up, how can people find you?
Yeah, you can just find us at foundationproperty.au. There's no .com in there. It's just foundationproperty.au. Send us a message. We'll see if we can help you.
Awesome.
Awesome.
Well, thanks so much for coming on, Alan, and I'll see you guys next time. A year ago, the answer to should I use my super to buy property was almost always some version of yes, and the how was residential with a loan. That's the part that's gone. What hasn't gone is the vehicle itself, or the reasons people wanted it, like the leverage, the tax treatment, and the control of where their retirement money actually sits. If you want us to look at your specific situation, the details are below.